Thank you for taking time to view this presentation of Penn National Gaming Incorporated, conducted by Team 3 of the MBA 660 class at Cleveland State University. The team comprises MBA candidates, including myself, Ravi Dodeja, and my three colleagues, Sarah Miller, Spencer Reed, and Andrew Charles, that you will hear throughout the presentation. We were tasked with preparing a strategic audit of Penn National Gaming, and the results of that project you will find on the following pages. Thank you.
Penn National Gaming is one of the many gaming and entertainment players operating within the U.S. Penn has done well in the market compared to the rest of the gaming industry, which Moody's predicts will decline in the short term because of flat revenues. They've done well specifically because of the spinoff of their gaming and leisure properties spinoff, which is detailed throughout this report, and their very efficient management team. Penn was also the employer's first choice in the 14th Annual Bristol Associates Executive Satisfaction Survey. Although there is intense competition in the gaming industry, Penn has been a very formidable player.
Penn's financial function and condition. At this section, we will look at the creation of GLPI, the tax ramifications, the conflicts of interest, and then the spin-off program. First, the GLPI was created as a separate entity. Penn contributed 17 of their properties to GLPI, and then basically they've spun these properties off, and then they rent the facilities from GLPI. This has huge tax implications. They're able to write off some of their rent expenses, some business expenses on their taxes. This obviously is a positive for their books. There is a conflict of interest here, though. Both their chairman, CEO, and another board of director member, they hold the same position for both GLPI and for Penn. This is obviously an issue. If you have the same leader for both companies, creating the illusion that you're completely a separate entity is essential for tax purposes, and I really don't believe that Penn can say that. So with that being said, the big key here is that Penn doesn't get into IRS troubles, because obviously for shareholders, stakeholders with the company, this could be a huge negative towards Penn in the future. The spin-off program, again, goes along with this GLPI concept, and it is basically a way that they are able to create these two companies. They're able to sell off the properties and then rent from that property.
So looking to Penn's marketing strategy, and more specifically to the place and the product components of the 4Ps of marketing, with respect to place, Penn currently does operate 27 properties across the U.S. There is a concentration of properties in the East and the Midwest sections of the United States. The company does currently operate one casino in Canada, but beyond that has no international exposure currently. And most of these facilities that are being operated are regional in nature. They are distributed. The site selection is such that it limits self-cannibalization of the prospective customer pool. And the company is targeting locals markets more than it is targeting tourist markets. Notably, Penn has a very limited exposure in Las Vegas, for example, only operating one casino there currently, and that facility is actually quite a distance from the famous Las Vegas Strip. In terms of the product offerings, there as well, Penn has taken a diversified approach to entertainment options for its customer base. And what we mean by that is that in addition to offering the expected casino fare, if you will, including slot machines that exist really at every property, table games, including roulette, blackjack, etc., that exist at properties that that are allowing such games, um, Penn has actually taken it a step further to add racing to the product mix, uh, further diversifying and broadening their prospective customer base. And then, of course, the company is offering hotels, dining, and other types of shows as part of their packaged offering to their customers. Moving to the pricing and promotion part of the marketing mix, Penn is certainly not seeking to be the low-cost provider in the segments that they serve, but they are certainly competitive within their given tier. On the promotion side, the company is heavily making use of print, radio, television, billboards, and online advertising. And as we see here, the loyalty program, the Marquee Rewards, is a significant component of their promotion, driven toward increasing customer retention and driving traffic to their regional locations, including the M Resort in Las Vegas.
Penn's internal factor analysis features many strengths and weaknesses, which have allowed for Penn to have a fairly healthy IFAS score. Strengths for Penn include growth, geographic presence, their unique product offerings, and a healthy financial position and the rewards program. Continuous growth is a major success factor in the gaming industry, and Penn has sustained this through effective management and an overall balanced approach to new initiatives. One of the ways they've grown, and another strength, is their geographic presence, acquiring and building new facilities in more suburban areas to avoid competing with larger competition. Penn's unique product offering of the racing, casino, or racino combination is a significant strength for them and has allowed them to access a wider range of customers in their suburban markets. Probably the most significant strength is Penn's financial position. Through increasing revenues, a healthy balance sheet, and most recently the spinoff of their gaming and leisure properties incorporated in 2013, Penn has been able to maintain a very healthy financial position. Weaknesses for Penn is the IFAS. In the IFAS include a larger market presence, such as Las Vegas, additional entertainment at their facilities, and the possible issues with the gaming and leisure properties spinoff. In the gaming industry, Las Vegas is known as the gambling and gaming capital of the world, so it is unfortunate that Penn does not have a more significant presence here. Although a possible future strategic move to expand, it is still a current weakness for the company. Also, having a lack of additional entertainment at their facilities, such as more shows or higher class restaurants, poses a slight weakness for Penn's facilities, as most people who go to a casino expect these types of entertainment. Lastly, the GLPI spinoff could pose an issue with the government if deemed a conflict of interest, giving Penn additional tax liability exposures if that were to happen. These strengths and weaknesses are shown weighted here and gives Penn a 3.05 IFAS score.
So the Pastel analysis seeks to reconcile the societal factors with the company, its current position, and its strategy going forward. Given the limits of time, we'll move through these rather quickly. Certainly on the political side, there's a constant tug of war between conservative elements that are seeking to limit the amount of gambling that's done in their state, with the other side that says that, well, gambling is going to be done whether we have it legal in our state or not, and we should be seeking to collect those dollars rather than allowing them to go out of state. On the economic side, there is a constant threat because the dollars that are spent in a casino and gaming environments are coming from disposable income. So a downturn or an economic downturn, increase in unemployment can significantly affect gaming operations revenues. These are highly leveraged businesses, and so this is a major risk. Socially, there is a stigma associated with gambling, and that presents a problem. On the technology side, of course, things are developing in ways that benefit gaming companies substantially in terms of increasing the amount of money that people can spend, the time that they spend in a machine. But of course, on the other side, there's consolidation within the industry that is creating challenges for a company that's looking to acquire equipment either through purchase or lease. And then finally, as we look at the legal environment, this is perhaps the most challenging environment given that state and local laws vary substantially as we move from state to state. Tax laws vary considerably, and of course the gaming commissions have substantial power. They are requiring a number of licenses and permits that can be revoked at any time, and of course that would render an investment in a casino in that state completely useless. So Pestel analysis certainly does present some opportunities for Penn, but probably much more challenges as we look at the various elements associated with it. So the gaming industry is highly competitive, seeing competition with other gaming companies as well as other forms of entertainment. Really, there are a number of success factors, but the ones that seem to be most important to a company such as Penn include location, brand image, betting options, financial position, management, and the offering of entertainment and non-gaming offerings. Given these success factors and with a focus on the regional distribution and diversification of Penn, we do see that Boyd Gaming and Caesars Entertainment are the closest competitors to Penn National Gaming. So the industry matrix that we see here in Table 6.1 does distribute the success factors and assign a weight and a rating for Penn and its two competitors, Caesars Entertainment and Boyd Gaming. Of course, we do value locations very highly as a result of that and the other factors and the operations of Penn. We see it as performing very well competitively against its two largest and closest competitors within the gaming industry.
Porter's Five Forces analysis is a framework to analyze level of competition within an industry and business strategy development. It draws upon industry organization economics to derive forces that determine the competitive intensity and therefore attractiveness of a market. Due to the high buyer power, high supplier power, and availability of substitute environments, we find the competitive environment is extremely competitive. The External Factor Analysis Summary, EFAS, is shown as Table 8-1. This table shows the external threats and opportunities that affect Penn National Gaming. The threats are as follows: regulations, online gambling, Las Vegas growth, tribal casinos, and economic uncertainty. We find the threat that holds the most weight is regulations, because state and local governments have the biggest effect on whether or not a casino can set up shop in their area. The external opportunities that we found affecting Penn National Gaming are emerging markets, cost-saving initiatives, strategic partnerships, and technology. We found that the opportunity that most affects Penn National Gaming is emerging markets. This is because not only can Penn go international, they can also spread to other states that are legalizing gambling. The next section shows the strategic factors facing Penn National Gaming and can be categorized into two sections: internal factors, IFAS, and external factors, EFAS. Each category portrays specific strategic factors that affect Penn National Gaming. As shown on the matrices on this slide, external factors, opportunities and threats, and internal factors, strengths or weaknesses, correspond to give an idea of where Penn National Gaming should go in their strategic thinking. We found that Penn National Gaming should expand into new U.S. and possibly international markets based on our analysis. We find that their strengths and weaknesses correspond to the opportunities and threats, and the best way for Penn National Gaming to overcome these threats and weaknesses using strengths and opportunities is to expand into new U.S. markets where gambling will become legalized. They may do so by either acquiring other companies who are in other regional markets and use their capital to help expand, or do so by themselves, building new casinos in new markets. The next section shows the strategic factors facing Penn National Gaming. It can be categorized into two sections: internal factors, IFAS, and external factors, EFAS. Each category portrays specific strategic factors that affect Penn National Gaming. As shown on the matrices on this slide, external factors, opportunities and threats, and internal factors, strengths or weaknesses, correspond to give an idea of where Penn National Gaming should go in their strategic thinking. We found that Penn National Gaming should expand into new U.S. and possibly international markets based on our analysis. We find that their strengths and weaknesses correspond to the opportunities and threats, and the best way for Penn National Gaming to overcome these threats and weaknesses using strengths and opportunities is to expand into new U.S. markets where gambling will become legalized. They may do so by either acquiring other companies who are in other regional markets and use their capital to help expand, or do so by themselves, building new casinos in new markets.
We have identified 3 strategy alternatives: infiltrate the Las Vegas Strip, expand internationally, and partner with a regional gaming company or to acquire one. Next, we'll go through each of those 3 alternatives and discuss the pros and cons to them. The first alternative is infiltrating the Las Vegas Strip. The pros to infiltrating the Las Vegas Strip is it's a huge market, it's the best gambling market in the U.S., and you haven't truly made it as a gambling company until you have that marquee Vegas Strip property. The cons are it's expensive, and it also requires a different business model than what Penn typically uses. The next alternative is expanding internationally. The pros to going international is diversification. You can also partner with a different company in a different country to share the risk of entering that new market. The cons is cultural differences, and obviously there are different laws in place in different countries. The third option is to acquire a regional gambling company. By acquiring a regional gambling company, you have a quick entry into new markets. The infrastructure is already there, so it's a very easy entry. However, the cons are you lack brand recognition, and you also must assume the company's debt that you are acquiring. Next, we'll look at the recommendation by our team to acquire a regionally based company. We have targeted the acquisition of Isle of Capri casinos. This will provide immediate access to 15 gaming sites. It will give Penn the opportunity to spin off the property to GLPI and take advantage of the tax advantages there. And the price would actually be the equivalent of 2 new properties. We took that based off of their Ohio properties. They spent roughly $300 million on their 2 Ohio properties, and we've estimated that we could acquire Isle of Capri for basically 100% premium at about $600 million, plus their debt, obviously.
Implementation of the strategic recommendation to acquire Isle of Capri casinos will start with an in-depth market research and due diligence of the company, followed by a budgeting process and assessment of capital markets, development of the pro forma financial statements. At that point, Penn may make overtures to ISLE, including issuing a letter of intent, closing the deal, ultimately integrating the company, and deciding whether to divest or to spin off certain properties.
The metrics for success are return on investment and earnings per share, cash flows, economic value added, and market value added. Return on investment is calculated by taking the net income over the total assets of the company. Earnings per share is the net earnings over common stock. Cash flows measures the abilities to pay current liabilities. This can be looked at through the current ratio, which is your current assets by your current liabilities. Economic value added is taking the after-tax operating income minus the investment in assets times the weighted average cost of capital. And then market value added is the present value of a future economic value added. So these are the metrics that we'll look at to determine if Penn has been successful, and we would like to look at them going forward in a 3 to 5 year period.